Hello and welcome to Within the Frame. I'm Handan Seoul. The Bank of Korea kept its key interest rate steady at 3.5% for the 10th consecutive time, hinting that it'll maintain its tightening policy for a longer period of time. BOK Governor Rhee Chang-yong showed a more cautious stance, keeping his guard up against persisting uncertainties. Similar stories played out in the U.S. with still too hot inflation dashing hopes for the Fed's widely anticipated rate cut in June. For an analysis of the BOK's latest rate setting and where global inflation is headed, we're now joined by Kim Sei-wan, professor of economics at Ewha Womans University. It's always great to have you with us.
Thank you for having me today.
And for further insights into the discussion, we also have Trinh Nguyen, senior economist at Natixis, joining us from Hong Kong. Welcome to the program.
Thank you very much.
Professor Kim, let's begin with you, and let's begin with the Bank of Korea's latest rate setting. What's behind the decision, and can we say that the rate hike cycle is now over?
Well, we can see that Bank of Korea is under a squeezed situation between stabilizing inflation and boosting up Korean economy. Current inflation is about only 3% on year, and it is actually pretty much stabilized compared to that of 2 years ago, 6% level. But inflation continues to stay around over 3% level, and it means that inflation is not fully stabilized down to 2% level, which is Bank of Korea's inflation target. For more aggressive fight against inflation, Bank of Korea can raise its base rate. However, Korean economic growth momentum is weakened from last year, with 1% level growth last year and 2% expected growth for this year. For a recovering economy, central bank should be cutting its base rate for increasing household consumption and corporate investment. As of now, it looks that Bank of Korea would not do anything on its key interest rate until U.S. Fed's base rate direction is decided between June and July of this year.
So inflation that still hovers above the BOK's target of 2% range is one of the main reasons behind the latest rate setting, and the BOK will have to wait for further clearer signals from the U.S. Fed until it makes its next move. Now, Trinh, mounting household debt is also one of the main factors hindering the Bank of Korea's possible rate cuts. The amount was more than double Korea's GDP at the end of last year. What are some of the biggest concerns regarding Korea's snowballing household debt, and would the country be able to see figures decline a bit within this year?
We're already seeing signs of progress for our household debt, which is quite elevated, right? So we have in the March figure, the actual number itself declined. But what's actually quite noticeable is the fact that we have a share of GDP decline for household debt, which is above 100% of GDP, and it has steadily declined. But that level is still quite high, and it's high relative to global benchmarks. And as a result, I think the BOK will still need to balance between containing financial risk, which is to say we don't want to raise interest rates so much that causes the financial system to crash because they maintain interest rate for too long. And that sets certain areas of stress such as project finance and construction sector and so on and so forth. But at the same time, it also wants some deleveraging of the bubble, right, in the system. And I think that's a delicate balance. The good news at the moment is that growth momentum is accelerating a bit. As the professor said, it was quite a weak year in 2023. Exports were double digits decline. The economy was dealing with very rapid, the overhang of rapid increase of rate. The BOK held in January 2023, and since then it has held at a 3.5% level, which is quite high relative to what the economy was used to. It was used to a very accommodative stance, and as a result, people took on a lot of debt from the corporate sector to the household sector. So all of this needs to start slowly deleverage for the BOK to feel comfortable to ease at the next cycle. So I think at the moment, holding rate is a comfortable place. for the BOK. And it's comfortable for the very reason is that not only does it have to want to deliver this mountain of debt for Korean households, which is taking place and gradually taking shape, but at the same time, inflation is nowhere near target, right? We have obviously inflation in the recent months due to food, and that's temporary, but the underlying factors are quite worrying as well. One is oil is creeping up, right? Brent is going towards 90, 91. Food inflation globally is going higher. More importantly, the Korean won depreciated year to date more than 6% because of the hawkish fresh. And such a depreciation of the currency means that imported costs passed through via FX is going to be quite concerning as well. So for the BOK, all these factors mean in the short term, we shouldn't expect any cuts coming from the BOK, in my opinion, because the data just doesn't give it space to do so. And it's finely balanced between all the factors we just mentioned.
You've brushed upon a wide spectrum of important factors in BOK's rate-setting decisions, but going back to the household debt, the Korean government at the beginning of this year announced it aims to reduce Korea's household debt to GDP ratio to below 100% by 2027, and so we'll have to see if that goal can be attained. But Trinh, as you mentioned, we are seeing some signs of a decline already, right? Household loans decreased by 5.9 trillion won in the first quarter of this year, so hopefully the downward trend will continue. Now, Professor Kim, another key factor behind the BOK's rate freeze is inflation, which still remains hot. You've mentioned briefly about this, but delving deeper into this, what are the main risks that continue to push up the prices?
Korean inflation in March was 3.2% on year, and it is higher than last year's 2% level. The main reasons for these higher inflations are higher oil price and higher agricultural product price, as Ms. Nguyen pointed out before. Particularly, even though the coverages of fruits and vegetables are only less than 4% of total CPI basket, their contribution to the whole inflation is significant because their prices are increasing much higher than other products. And international oil prices picking up again recently. Dubai oil price exceeds $90 per barrel from last week, and it gives more pressure on domestic price level. And it is also expected that oil price continues to rise until the wars in Gaza and Ukraine are stabilized. In addition, we are experiencing rising fruit prices and other vegetables prices these days. For example, people say that normal apple became gold apple due to skyrocketed apple price. Actually, the apple crop is in bad shape from last year, and it raised apple price more than 3 times. The problem in domestic inflation is that it is not easy for Korean government to control these prices because they are determined by foreign factors and weather conditions. So it is strongly recommended to import some key fruits like apple from other countries for stabilizing inflation.
So there's, of course, the high agricultural prices and high oil prices, and also geopolitical risks that continue to rise that are pushing up inflation here in Korea. And I think you've also mentioned a very important part about how the prices of apples, for example, the prices of vegetables, it's getting harder for the BOK to tame the prices through fiscal policies because we're getting affected by some external factors. So it seems like the country needs fresh, new import measures to deal with that. And Trinh, the BOK's rate-setting decision is not entirely free from the U.S. economy and the U.S. central bank's stance. U.S. inflation for March came in hotter than expected, climbing 3.5% on year, while the country's producer price index recorded a 2.8% fall. What's your analysis of the latest indices, and how would it impact the U.S. Fed's future interest rate decisions?
What's very clear is that the Fed needs to have data to cut, right? Because this is an election year, it doesn't want to come across as not data dependent. And the 2 key mandates of the Fed is really jobs jobs have to start to crater, it have to show weakness, and jobs are very, very strong. The second, of course, is inflation. Inflation has to decelerate to give space to cut because it shows that the tightening so thus far has pushed down prices because it's pushed down demand. Now, that's not what we got in March. What we got was inflation accelerating. Now, what's really worrying is not just the headline, but also the core inflation is much higher than headline, which is 3.8% year on year. And that is really a worrying sign because it means that we don't really have the numbers for the central bank to cut. And as a result, the economy is running still too hot, and therefore we're not expecting interest rates to be cut anytime soon because, you know, at the May, the June, July meeting, we need data to be deteriorating very rapidly, not just once, but multiple times. And that data is not coming through yet. So as a result, I think markets is very, very, very concerned about this inflation data. And it's also concerned because it's not just a domestic US issue, but also increasingly a global challenge, right? Inflation within Asia is also accelerating with many countries, not just South Korea, Singapore, and so on and so forth. And global inflationary pressures driven by food and oil prices rising is also a concern. And added to this, Korea and Asian economies have the third factor, which is the fact that most of the trade is still denominated in dollar. And the dollar is very strong, and the domestic currencies has depreciated quite significantly. So we're also importing inflation when the dollar is so strong as well. So looking ahead, we don't expect the Fed to cut anytime soon because it just doesn't have the data to allow it to do so.
So you're worried, you're concerned, not just about the headline inflation, but also about the core inflation continuing to rise and the inflation not just becoming a U.S. domestic problem, but a global challenge. And Trinh, you briefly mentioned about strong jobs report. And the strong figures are dashing hopes on the Fed's widely anticipated rate cut in June. And Jamie Dimon, the head of JP Morgan Chase, has even warned that the U.S. interest rates could climb to 8% due to persistent inflationary pressure. What's your take?
Well, actually, he said it could be 8 or it could be 2. So he actually has a wide spread, right? Somewhere between he could be right. But I think the point of what he's saying is that we actually have very little certainty about the future direction of inflation. That's true to be said, what the BOK said today. It's very true for the Fed, which is, as Jerome Powell wanted to say, was that, you know, the January and Fed data was a bump and that we're actually getting to where we need to go, which is decelerate inflation, which is actually not happening, right? Because once expectations are well anchored, wages have risen, and then it becomes endogenous. And now that is a big issue. Now, there are two questions for that. The question is, where will longer term interest rates settle, right? So, for example, the longer end of the U.S., and not only there's uncertainty on the shorter end of the curve, which is, big repricing of Fed cut. In the beginning, we had a lot, and now we're only narrowed down to less than 2 cuts. And so that's a lot of uncertainty in the short-term rate cuts with the Fed. But also there's a lot of uncertainty in the longer-term interest rates as well, because where are we going to land in terms of inflation? And now the question why we say this is that there are significant shifts in the global economy that point to this. One is that there is reshuffling of supply chains. Reshuffling of supply chains mean that we're pulling away from the natural gravity of supply chains, which means increasing costs. There's decarbonization efforts, which causes costs to go higher, and so on and so forth. And not to mention geopolitical tensions putting bottlenecks on supply chains and global supply chains, right? So all these factors are important. But more importantly also is the fact that the Fed stimulated economy via QE. And the fact that it's done a lot via interest rate hike, but its balance sheet is still quite large, right? It's, balance sheets for the Fed before COVID was roughly 3 to 4 trillion, which is quite large relative to what it was before the GFC, right? And so now we have actually climbed down from this huge balance sheet to roughly 7 trillion now. So there's still a lot of money sloshing around. So all of these factors are coming together to create both from the quantity of money to the supply side shocks, all create a lot of uncertainty surrounding short-term interest rate and longer-term interest rates, and all relating to fact is that most people have no idea where inflation is headed. We all hope that U.S. inflation would decelerate over time, right? The fact is high interest rates should crush demand and therefore should push down inflation. And so far, we're not having that, despite of the fact that rates have stayed high since July last year. And as a result, I think there's a lot of level of uncertainty. And what that means is that we're already seeing term premium, right? One of the calls that we've had as a team is that there should be a steepening of the yield curve. The yield curve was inverted because investors thought the Fed was wrong, right? They would capitulate, and that their forecast of 3 cuts were wrong, and that markets were right to forecast much more, doubling of that. But in fact, markets were wrong, and in fact, even the Fed may be too optimistic in the 3 cuts, right? We still are quite uncertain. But what we do know at the moment in April, we don't have the data for cuts, which means that we need data to do so, and in order to do that, we don't expect that to happen before the summer, and it's very likely to happen in Q3 at the earliest.
A lot of uncertainties for the markets and investors, but what we do know for sure is that the U.S. Fed is in no rush to cut rates. Now, Professor Kim, timing of rate cut also remains uncertain here in Korea as well, amid lingering risks. Many economists project we'll have to wait at least until the 3rd quarter to see the start of rate cuts. What's your forecast?
Well, I pretty much agree with interest rate cut forecast in 3rd quarter. It looks that U.S. interest rate cut is more likely to be more delayed thanks to sticky U.S. inflation, as Ms. Nguyen pointed out. They also are experiencing well over 3% inflation on year from last year. And Bank of Korea is expected to cut its rate after seeing U.S. Fed's interest rate cut to avoid further Korean won depreciation from higher interest rate gap between U.S. and Korea. As of now, the 2 countries' base interest rate gap is 2%. And if Bank of Korea cuts its base rate, that depreciates Korean won further and drives up domestic price level well over 3%. According to developing economic situation of the United States, Federal Reserve interest rate cut timing is more delayed, I think, after June of this year. However, Bank of Korea can't let domestic economy get worse forever with higher interest rate, because in the long run, to policymakers and people of Korea, the income and employment is relatively more important than inflation risks. So before domestic economy loses its recovery momentum, Bank of Korea can cut its rate in the second half of this year without seeing U.S. Federal Reserve interest rate cut.
So the U.S. Fed's signal is important for the BOK, but what's even more important for the Bank of Korea right now is the domestic factors, such as high inflation as well as high exchange rate, which will push up the import prices higher, and the inflation cycle continues. Now, Trinh, meanwhile, foreigners' stock investment in Korea in Korean markets hit a record high in the 1st quarter of this year, reaching a total of 15.8 trillion won, or roughly $11.6 billion. It marks the highest level since the government's first data in 1998. What do you think were the contributing factors?
Well, I think there are 2 reasons for this. One is Korea, we expected to have a cyclical recovery, as we mentioned, and another reason why the BOK doesn't need to cut in the short term. The ICT cycle is on the upturn, and many of the big companies in Korea should benefit, Samsung Electronics and so on and so forth. The second factor is geopolitics, right? Korean firms are a key beneficiary in this geopolitical tensions between the U.S. and China. It's a key beneficiary, whether or not it's the CHIPS Act or the IRA, the Inflation Reduction Act, because Korea has an FTA, it is being favored. The fact that it actually has a supply chain that the West needs, and so therefore it can compete in the U.S. without a huge competitor like China. And more importantly, when investors reshuffle and they want to diversify from China, there are only a few markets where they can move to. And I think Korea is one of them, and as well as Japan, India, and so on and so forth. Because even though ASEAN markets are quite attractive, in terms of public equities, they're not big and have debt and so on and so forth, big enough. So as a result, I think that's one of the key drivers of Korea attracting flows. And it's not just in equities, also bonds, right? Because bond flows have been quite strong, not just this year, but also last year, due to expectations of inclusions to FTSE Russell inclusion. And then, of course, people expect eventually Bank of Korea will need to cut. The next move is not hike. And as a result, this should help the economy with its recovery.
We're a little pressed on time, so Professor Kim, just very quickly before we let you go, the Korean government will soon unveil detailed guidelines of its new Value Up program designed to tackle undervaluation in local stock markets. What sort of details do you expect, and what are your prospects for the program?
Since Korean government has decided to pursue Value Up program in a market-friendly way, it did not give an immediate impact on the markets when it was announced last month. For having more foreign and domestic investors in equity market, the success of Value Up program is very important in the long run because quickly aging society in the next 20 years naturally decreases equity investors and the market size. To invite more participation of the Value Up program, government will strengthen communication with companies through relay briefings for listed companies in Korea from large cap sized to small cap sized. And that is something more detailed planned for Value Up program as of now. But there will be more details will be announced in the next month.
All right, we'll have to leave it there for tonight. Thank you so much, Professor Kim and Trinh, for sharing your perspectives. We appreciate it.
My pleasure.
And that brings us to the end of the show. Thank you for watching, and be sure to tune in same time next week. See you then.